Hi, I'm Rishit Shah from Tele School and welcome to the second video of the Basics of Accounting course. So I'm assuming that you have watched the first video up to the last minute or last second so that you can understand everything. In the last video, I explained about major accounting statements and of course what is accounting, that many people don't tell you what is accounting. It's simple as I explained in the previous video, and if you haven't watched the previous video, I would highly recommend to watch the previous video because this video is exactly a continuation part or is based exactly on the previous video. So if you have not watched it, go watch it now. Okay, so starting with this video, in this video I'm going to explain you some terms used in accounting, some simple terms that are widely used in accounting, and you seem to a bit like confused at what the hell is that. So I'll explain the terms and you don't have to get confused anymore after watching this video. So let's start. The first term, assets. Now in the previous video I told you that I'll explain assets and liabilities in detail, what are assets and what are liabilities. So let's start with assets. What is an asset? Asset is something that you own and that can give an economic benefit until the future. So in simple words, it's something that you have and you can benefit from it. So for example, say you have a vehicle, a car, and you can benefit from that car by renting the car. That's an asset. Asset is something that you can benefit from. Understand this or remember this simple rule. Asset is something that you can have an economic benefit. Economic is the word. Economic means in terms of money you can benefit from. So that's an asset. So let me give you some examples about what are assets. So if you are working for some company or if you are doing job, you are going to have to work on laptop or computer. So that's the asset of the company. If you are going to office, the office building is the asset of the company. They are all assets because they are benefiting from that asset. They are doing business and they are profiting, or they are earning profits, earning money. So that's economic benefit for them. In fact, you as a human or as an employee of the company are also an asset that cannot be quantified in terms of money, but it's a biggest asset. So asset is something that you can benefit from and you own it, you have it, you have to own it. Okay, if you rent it, then you own it for a limited period of time, but still you own it. If you buy it, you have it for lifetime and you own it. So let me recap what is an asset. Asset is that something you own it or you have it and you can economically benefit from that. That's an asset. So moving to the next term, liabilities. Liabilities is exactly the opposite of asset. Simply, it is the opposite of asset. So liability is that you something owe or you have to give someone something. That's a liability. So let's continue with the previous example I gave about your company. If you're doing a job or if in your family anybody is doing a job, then you must be getting a salary from the company every month. So the salary you get is the liability of the company. They have to pay you or your relative who are going to the job a salary. That's a liability. So every asset has a liability attached with it. Remember this. Say for example, uh, you have a mobile phone, and that's an asset because you own it, and you can benefit from it economically by sending messages which are convenient, by sending emails, but you have to pay for the internet. So that's a liability, and your mobile phone is an asset. I think this example you will understand better. Mobile phone and internet. Another example we can take of liability is that you have a house, that's your asset, and you have to pay for electricity bill, telephone bill, internet bill if you have one. So that's liability, and you have to pay the liabilities in order to use the asset. So asset comes with a liability that you have to pay in order to use the asset. So in accounting terms or in accounting language, liability is that something you owe, and asset is that something you own. So asset is something you own, and liability is something you owe. So asset and liabilities, major terms in accounting. Next one is incomes. So be sure that incomes are different from assets. Asset is something that you own and you can economically benefit from. Now, that economic benefit is in the term or is in the form of income. So don't confuse it. For example, asset, you have a building and that's your asset. And if you're earning money by renting that building, the rent you earned was your income on your asset. And you have to pay the liability. At the end of the month, you have to pay electricity bill. So that's your liability for now. Okay. So income and assets, don't get confused. I'll explain one more time. Asset is something that you own, and income, the economic benefit you derive from that asset, is the income. So let's take the example once again. You have a car. That's your asset. You give it on rent to earn some money. You earn some money. That's your income. Okay, so now the next is expenses. So what is expenses? Don't confuse expenses with liabilities. Liabilities are what you have to pay. You don't have to pay it now, but you have to pay in the future, and you account it for in the present. So taking the example of car, you have a car, that's your asset. You give it on rent and you earn some money on rent, that's your income. Now, when you had the car, you have to incur, or you know that you have to pay for maintenance and for petrol. So you know that. So that's your liability. And when you give that money, when you expend that money for petrol and maintenance, so that's your expense. So many people get confused between assets and incomes and liabilities and expenses, but they are very simple once you understand it very easily. So if we take the example of building one more time, and we can include all the four terms in that, I'll explain that right now. So taking the example of building, the building you own is the asset. So when you give the building on rent and earn some money, that's your income. So when you had the building, you know that you have to pay for taxes, electricity bill, telephone bill, maintenance of the building, everything. So you knew that. So that were your liabilities. So when you actually pay your liabilities, that's your expense. And when you pay the liabilities in the form of expenses, your liabilities gets over. So for example, you have building and you give it on rent for a year, for 1 year. So for one first year, whole year, for simplicity, let's say your rent was a lakh rupees. So the income you earned was 1 lakh. The asset you have is the building. So assets and incomes are clear. Okay. So the income you earned was 1 lakh and the asset is your building. You own that building. And when you gave it on rent a year before, you knew that you have to pay bills, electricity bills, maintenance bills, everything. So that were your liabilities. And for the sake of simplicity, I'm explaining this. At the end of the year, you have to pay all your liabilities in the form of expenses. When you pay, say for example, on 1 lakh of rent, you have to pay 30,000 as your expenses, everything, maintenance, bills, etc. So that were your liabilities. And when you pay 30,000 at the end of the year, your liabilities gets to zero. And for another year, you have to pay this all at the end of the next year. So that were your liabilities. And when you paid 30,000 at the end of the year, that was your expense. So I hope you understood that 4 terms: assets, liabilities, incomes, and expenses. So whenever from now you see that, you'll not get confused. And still you have any questions, you can directly comment it and I'll happy to answer. So moving forward, yes, some more terms are left. Debit. So what is debit? Debit means what comes in terms of accounting. What is debit? You debit what you get. Debit means addition and credit means subtraction. In simple terms, though they don't mean like that. So debit is what you get and credit is what you have to pay. So let's say you get cash, so you debit it, and you have to pay cash, so you credit it. So debit is like a plus sign and credit is like a minus sign. You have to imagine that, and you have to practice some bit of practice imagining this, and you will get used to it. I got used to it like that. I got a bit confused in start, but eventually I learned it. So debit is what you get, all the additions in your business, and credit is all the deletions in your business. It's for the simplicity, don't get confused, because all incomes are credited and all expenses are debited. I'll explain the process in later videos, but for now. So what's credit? So what credit means, that goes out in the business. Okay, think from the perspective of a business. Now next is profit. Profit, simply when your incomes are more than your expenses, it's called profit. And loss, when your expenses are more than your incomes, it's a loss. I think there's no person who watching this video don't understand what's a profit and what's loss. So here comes the accounting rule that you have to remember. Whatever happens, this accounting rule applies. Debit what comes in and credit what goes out. Now it's the basic. For the basic, I'm explaining you debit what comes in and credit what goes out. In accounting terms, you have to debit what comes in and you have to credit what goes out. So let's say you get cash, so you debit cash account, and you pay cash for, you get cash for sales, so you debit cash account, and you pay cash for your expenses, so you credit cash account. That's the accounting rule. Debit what comes in, credit what goes out. So remember this accounting rule, and if you ever get confused what to do, just remember in your mind this accounting rule and your confusion will get over. One thing to note here is that I'm explaining all this stuff or all this accounting basics as a perspective of a business, as you are doing a business or you are doing a personal business that you will get benefited from. So if you think from the perspective of business, you will get more clear in accounting. So moving on, some more terms are used which are used in accounting. Ledgers. Now this is used in tally also, and this is used in general accounting also. So what are ledgers? Ledgers are basically the names of accounts which are created in tally, or which are created when you write accounts. So say for example, you made sales in your business, so you have to create a sales ledger. Now you made sales to some ABC company, so you have to create a ledger, another ledger for that ABC company. And let's say you made some expenses for, let's say, advertising expenses for making that sales. So advertising expense, you have to create another ledger for advertising expense. So if simply I can explain what is ledger, it is just a segregation of everything you do in your business, so you can go and get a good understanding of what is there. So your ledgers is nothing but it's just distribution of accounting information according to what happened. So you can understand accounting better by just looking at the accounts. So ledgers are nothing but distribution of information in different types of accounts. So many people get confused between ledgers and accounts. So they are the same, but the accounting word is ledger. So whatever you do, you have to create a single ledger for a single type of transactions. So for sales, you have to create a sales ledger. For purchase, you have to create a purchase ledger. And if you are purchasing from someone, you have to create a ledger for that. If you are selling to someone, you have to create a ledger for that. So it's just distribution of information in different types of accounts or in different areas, so you can learn or you can see accounting better. That's ledgers. Some examples of ledgers can be cash account, bank account. Now in bank account, if you have different banks, State Bank of India account or Bank of Baroda account, they are all, you have to create different ledgers for that bank account. And moving on to capital account, that I'll explain later in the balance sheet video. So expenses account, and in expenses, if you incur different types of expenses, that's advertisement expenses, selling expenses, other expenses, the ledgers are created just for distribution and segregation of information, so you can view or you can see account in a better form, in detailed form. So let's say you are doing business and you just have purchase ledger and sales ledger, nothing in that. You don't create the ledgers of every people you sell to or you purchase from. So if anyone looks at your accounts, he'll just know that purchases are say 5 lakhs and sales are say 6 lakhs, so you profit 1 lakh. So let's say you want to know how much you purchased from ABC Company Limited, for example. You can't know that because you haven't created a ledger. So if you have created a ledger of ABC Company, you would know that you have purchased 3 lakhs, for example, from ABC. And this information is very important to know what you are doing in your business. So ledgers are very helpful in segregation and distribution. So you have to create a ledger for every single type of transaction you make. So moving onward, vouchers. Now vouchers are created when you do some transaction. Another word is entries. Now vouchers and entries are interrelated. When you pass a voucher, you create entries. So for example, you sold some goods worth rupees 1 lakh. So you have to pass a sales entry. In simple words, we tell that, but that does not mean in accounting terms. It means that you have to pass a sales voucher. If you do a sales transaction worth rupees 1 lakh, you have to create a sales voucher, and in sales voucher you have to create 2 entries. They are called entries. The number one entry is that you sold goods worth 1 lakh. That's the first entry, or that's one part of the entry. And the second entry will be you got cash 1 lakh. So you got cash 1 lakh, that's a single entry, and you sold goods to that company, that's a second entry. So that's why it is called double entry of accounting. You heard it many times that we now follow double entry of accounting system, but that is the reason we call it double entry, because you pass two entries for every single transaction you do. So let's say, for example, you purchased goods worth rupees 50,000 from ABC Company Limited. So what you will do, you will create a purchase voucher. Listen to the word voucher. You'll create a purchase voucher, and in that voucher you'll create two entries. You will debit purchases and you will credit cash because you got goods. So debit what comes in. Remember the rule, debit what comes in. You debited purchases because you purchased the goods, and you credited cash because cash goes out. You paid the cash. So debit what comes in and credit what goes out. So now these are the vouchers and entries. Okay, so now a few more important terms are left out that I want to explain to you in this video, which are debtors. So now, what are debtors? When I was explaining about purchases and sales, I said you got some goods, that's purchase voucher, and you paid cash. So you paid cash. Okay, so what if you do not pay cash? You just want to pay cash after 15 days or after 30 days. Now this is general in all businesses you do. You do not pay cash immediately in big businesses. Ask somebody if you know that they are in big business. They have a cycle that is called a credit cycle, that they purchase goods on say 1st of the month and they pay the bill or they pay the cash after 15th date or after the month. So this cycle is called a credit cycle. So let's say you sold some goods to BCD Company Limited, and you and BCD Company Limited agreed that you will get the payment of your goods sold after a month. So for the month, BCD Limited are the debtors. You have to take cash from BCD Limited, so they are your debtors. The debtors are your assets. So now this seems like confusing, but it's simple. Just remember what are assets. Assets are something that you can economically benefit from. So obviously you are economically benefit from BCD Company Limited because you will be getting cash because you have sold goods. And what's the economic benefit? Profit. Okay, so you sold goods, say for 10,000 to BCD Company Limited, and in that your profit is 1,000 rupees. So let's sum it up together. You sold goods of rupees 10,000 to BCD Company Limited, and you and BCD Company Limited agreed to pay for the money that BCD Company Limited owes to you after a month. So you will be getting your cash rupees 10,000 after a month. So for a month they are your debtors because you have to take money from them. That's the word debtor in accounting terms, when you have to take money for some goods sold to them. So for a month, BCD Limited are your debtors, and debtors are assets because you will economically benefit from BCD Limited in the form of profit. So I hope you understand what are debtors. When you sell something to anybody and that anybody agreed, in our example BCD Limited agrees to pay or to get you the cash after a certain time, which is called a credit cycle, which is general in every business, they become your debtors. And if you look at from the perspective of BCD Limited, you are their creditors because they owe you money, and the same creditors are liabilities as debtors are assets because they have to pay you money. So they are your liabilities. So when you get profit, after you get cash, you also get profit. So profit is your income. Okay. And when they pay you, so they pay you, that's their expense because they pay you. Okay, so these are debtors. Oh, I explained creditors pretty much. So what are creditors? So taking the example just explained, you are the creditors of BCD Limited because they purchased from you and they agreed to pay you cash after a month. So you are their creditors. This is the term used in accounting, creditors, when you purchase something and that another party agrees to make a payment after a month. So when you purchase something and you agree to make payment after a month, then the creditor arises. So taking the example above, BCD Limited purchased from you goods worth rupees 10,000. So you are their creditor because they owe money to you. Whenever you owe money for purchasing goods, you become a creditor. And whenever you are going to get money for selling goods, they become your debtor. So it's a bit confusing, but it's simple. You'll get used to it. So whenever you sell goods and you agree to get money after a month, the other party who agreed to pay you money is your debtor, and exactly you are the creditor. So when you understand debtor, the creditor is exactly opposite. So if the party opposite to you is your debtor, then you are the creditor, and when you are the debtor, then they are the creditor. It's as simple as that. When you sell something and when you agree and that other party also agrees that a payment will be made after a month. So you have sold and you are going to get a payment in cash after a month. So in this case, they are your debtors and you are their creditors. Okay, so moving on to the next, inventories or stock. This is simple. This is not as confusing, and this is not an accounting term to be specific. Stock, it means all the stock you sell in your business. For example, let's say you have a business of mobile phones, so all the mobile phones are your stock. It's pretty simple. In every business there is a stock, except for the service business. They sell services, so they have no stock. But in general, every business have some stock. So stock or inventory, whatever, the meaning is same. So for example, I have a business of books, that is booknagri.com. I sell CA and CS books on booknagri.com. So you can visit it now to buy CA and CS books. I have a huge discounts on that books in the industry or online. So the books are my stock or inventory. That's pretty much simple, and that is also my asset. If you remember, asset is what you can economically benefit from. So I'll be benefiting from book. When I sell those books, I earn a profit in the form of income. Okay, so that were the terms of accounting, and in between I also explained the accounting rule, which you have to remember no matter whatever. That rule is debit what comes in and credit what goes out. So in the next video, I'll be explaining you some accounting entries. moving on to the accounting entries now. The basic part, or the most amateur or most simple part of accounting is over. You understood what is accounting, you understood major accounting statements that are generally used in the industry or in the real world. You understood the accounting terms, the generally accounting terms that are used in real world. And now I'll be explaining order accounting entries, simple accounting entries about sales, purchases, and so on. So thank you for watching this video. I hope you understood what is accounting and accounting terms and accounting rules. If you really like the video, please share it with your friends who don't know what is accounting or who want to know the accounting terms. And if you liked it, give a like down below the YouTube video, and if you have any questions regarding this video, you can post it in the comments. I'll be more than happy to answer it. So thank you for watching, and stay tuned for the next video, that is accounting entries. See you in the next video.